Hey guys, how you doing? I'm Kent Tilley. Welcome to the channel. And today I want to talk to you about why your conservative portfolio is down so much this year. This information's actually pretty hard to find because what's happening inside of those conservative portfolios is that they own a whole bunch of bonds, and bonds are, tricky as far as the market is concerned with bonds. The bond market is absolutely huge, and there's not as much information on the bond market as there is on the stock market. So I can talk to you guys today about one of the reasons. There's probably a lot more behind the scenes that I have absolutely no idea about. And another thing that I'm going to do at the end of this video is sort of make a prediction based on what might happen with the bond market due to what's happening in the economy today. So I don't like making predictions. I mean, probably the last time I made a prediction was like a year and a half ago when I said that I was worried about the market. And one of my things that I said in that video was, one of the ways to sort of alleviate the stress of a market sort of crash is to own more conservative investments in your portfolio. However, that hasn't actually worked out that well because both the stock market and the bond market have been dropping at sort of almost equal rates this year. In a normal world, that's not usually how it happens. Right now, the bond market has hit its first bear market in the bond market in over 40 years, which means it's down more than 20%. Usually when the stock market goes down, bonds sort of hold it up. That's kind of what's supposed to happen, but we're not really in normal times. So I'm going to try and explain why this is happening and what I think might happen. I mean, obviously, I can be wrong. I don't really like making predictions because who the heck knows what's going to happen in the future. But to understand how the conservative portfolios are down, you need to understand what is inside of them, which are predominantly bonds. And how bonds work is it'll tell you exactly why they're down. So if a company or the government wants money and they don't want to sell shares, so if it's a company that doesn't want to sell shares in their company, they need to raise money, so they do that in the form of bonds. And generally speaking, let's say the government needed money to build a road. So they would say, okay, investor A, we need $100,000 from you. We want you to give us $100,000, and we are going to pay you, let's say 2 years ago, 2% interest for 10 years on that $100,000. And so they're going to make whatever, $200 a year, or $2,000, sorry, on 100,000, every single year for 10 years. And then at the end of 10 years, they're going to give you your $100,000 back. And so that 2% is where that comes into play. It says the fixed income investments that you own, because it's paying you 2% a year to own that bond, and it's fixed. Now, some companies that offer bonds that are higher risk, they have to offer higher interest rates because there's more risk of them potentially not being able to pay you back your principal. But with huge companies and the government, your hope is, yes, you're going to get your investment back and you're going to get that fixed income over the term of the bond. But what has been happening lately, because inflation has been so bad, what they've decided to do, as you all know, is they're raising interest rates. So basically, if there's a new bond issued all of a sudden, they have to offer higher than 2% interest on that new bond. So they might say, okay, now we're going to pay 4% on the bond. So A new $100,000 bond is paying $4,000 compared to your old one that's only paying $2,000. So that actually makes your bond less valuable on paper within the trading of all of this. Because it's like nobody wants to buy a bond that's only paying 2% when they can buy a new bond that's paying 4%. So if you were going to go and buy that bond off of somebody, then they have to offer it to you as a discount. And that is why the bond market has dropped. However, there is some good news in here. So if you own a lot of a fixed income portfolio and you've seen it go down, well, that also means that every time these are maturing or you're buying new bonds, that the income that is being produced from all of them is higher than it was before. So all of the new bonds that you're buying should be paying a higher fixed income rate than all of the old ones that you used to own that have gone down in value. So your income is actually going up. And where my prediction comes in with the conservative portfolios and the bonds is, generally speaking, I guess the consensus has been around the world with a lot of economists is that this raising of interest rates is going to force the economy into a recession. This isn't just Canada. This is happening everywhere that you're looking, because every country sort of operated the same way when it came to COVID. They took some money. They didn't know where they were going to get it back. They gave it to people. It caused inflation. Now we need to tame that by increasing interest rates to tame inflation, which is going to cool off the economy. Now, if they cool off the economy too hard, that's going to drive it into a recession or even worse. And technically, on paper, as far as the definition I know of what a recession is, the United States is already in a recession, but nobody seems to be talking about it in the newspapers for some reason. But that's beside the point. So if the economy goes into a recession, and they've been raising interest rates for the last, year or whatever, and are planning to keep doing it, eventually that is going to have to flip on its head, and they're going to have to lower interest rates again in order to try and stimulate the economy back up. It becomes this cycle, and if that happens, so if there's an end of them increasing interest rates and now they start to drop them to try and stimulate the economy again, that entire bond portfolio that you have starts to see an actual increase, potentially before the stock market even increases again. And this might show a shift where you see them from time to time where, bonds are really outperforming the stock market, and then people start getting into them because they feel safe, and then it was actually too late and you should have been back in the stock market. So I'm not telling you to try and time these trades like this. I'm just saying this to help you kind of understand what is happening inside of that conservative portfolio, because you own it under the impression that it's not really supposed to lose money. It's supposed to be safe, and that hasn't been the case this year, which is definitely unfortunate. But I mean, at the end of the day, what I'm really looking at isn't okay, how are you going to time things and make the perfect amount of money? No, we're just looking at reasonable projections of returns based on your portfolio and saying, is that going to help you achieve your goals? Because at the end of the day, that's more important than, day to day, did I make the most money this year or last year, or I'm chasing these things. You switch it around too much, you're more likely that you're just going to lose. So you kind of want to stick with your game plan when it comes to investing, and take risks if you have the money to lose. But, it's hard, it's emotional, but that's what's happening in my mind. And, don't take it and say, this is exactly what's going to happen. I obviously don't know, but just wanted to give you a little bit of an idea of what I thought about it. And hope you learned something. Hope that was informative. Hope it helped you a little bit. Maybe sleep at night if you're stressed out a little bit. And thanks for watching. Please subscribe if you haven't, and we'll talk to you guys again very soon.